All right, so this is what I want to talk about and start to model out. This is the announcement that happened on February 20th, 2013. It says right here that Office Max and Office Depot announce merger of equals with a couple points, right? Two leading companies combined, just kind of advantages. Customers will benefit through unique, innovative products, whatever. They mention anticipated annual synergies of 400 to 600 million, resulting in improved cash flows. And they mention an adjustment to the board of directors. So my question to you is, from a subjective standpoint, how can you figure out what kind of merger this is? Is it horizontal? Is it vertical? What are the terms? How do you think about that? How do you talk about that? It's important in a case. What is this? If somebody says, what are you doing? Whatever you're doing at NYMEX, what are you doing? How do you talk about it subjectively? Using the right keywords and the right terms. How would you categorize this?
Well, would they mention that at all in like filing statements of
Well, they'll mention pieces of it, but you got to be able to package it and present it, AJ.
So the fact that it says merger of equals signifies that it's a horizontal integration. Like it's standing.
It may or may not.
No.
What categorizes it as horizontal?
So that if it's horizontal, everything is mixed up. If it's horizontal, it's like to gain market share.
Right.
And like the supply chain.
Horizontal is merging with a competitor. The goal is usually to gain market share. A competitor is somebody that's producing the same product as yours. Vertical is acquiring somebody that's up or down your distribution chain. We talked about energy companies, a driller buying a gas station, or a driller buying a pipeline. They're up and down distribution chain. Merger of equals just means the two companies are of similar size. It doesn't necessarily, although, yeah, that's probably a hint that it's most likely horizontal. Not necessarily always the case, though. What could that indicate? How else can you categorize this? Yes, Danny.
So a merger that probably will fail because they don't know who's going to lead what part of the business.
I wonder how it's doing right now. Does anyone know? Has it been doing pretty well? I should look at
Historically, that's been an issue with
mergers of equals.
Yeah, I don't say that tongue in cheek. It's just a problem with companies not understanding who's leading what.
In the management? Well, that could be, right? The fight for management. Maybe that's why they mentioned that as a specific point. They got the management figured out. I don't know. I don't know the statistics on that. What else? How else would you categorize it? It's horizontal. There might be some vertical components if one or the other has distribution chains that the others don't, but it's probably 100% horizontal in this case. It's a merger or consolidation. What's the difference?
Merger, because they're both equals, and they have like a shared board of directors. It's consolidated, and one company gets they give 51%.
It could still be 51%. The difference between merger and consolidation is a little bit different than that. What's the difference between merger and consolidation? A consolidation, a new entity is created. In a merger, there is clearly an acquirer and a target. So in this case, it's kind of hard to see here. We have to read on. But just because it's merger of equals is not necessarily an indicator of one or the other. The question is, what's the remaining entity that's being created? And let's see. Do they say here? If you scroll down, and this had to take some digging. Here, under the terms of the agreement, Office Max stockholders will receive 2.69 Office Depot shares for each share of the Office Max common stock. So what does that indicate for you, the type of transaction which will help us determine whether it's a merger or consolidation? What do you think?
I'd say it's a merger. Citizens are pretty clear.
Yeah, but explain for me the terms then.
Well, with the stock swap.
It's a stock swap.
Yeah.
Okay. This is a stock swap. Right? And with the stock swap, you were going to say?
I was going to say it's just pretty clear that you're applying
Yeah.
consolidation. You
Yeah.
don't just see a stock swap.
Given it's a stock swap, it's pretty clear that there's one acquirer and one target. One person is issuing Office Depot is issuing their shares to buy out Office Max shares. Right? Office Max shareholders will receive 2.69 Office Depot shares. So what's the surviving entity? Office Depot. It's a stock swap.
How do you know that it's a surviving just from that one sentence?
Yep. Office Depot will be raising shares and giving it to Office Max stockholders.
Okay.
Office Max will go away.
But I think in this presentation we are going to have to reform like this one will be
No, I think it's still Office Depot. They might call it Office Depot Office Max. Oops. Yeah, Office Depot. I think they might have, yeah, okay, Office Depot is the holding company. Office Depot, Office Max. I think they're actually winding down. Let me go to the regular.
It says Office Depot.
Where do you see that?
Ticker.
Oh, good. Yeah, okay, so they still consider it. But I don't know how accurate that is. But yeah, I think when I looked at it this morning, it was Office Depot, and then in small letters, it was kind of like Office Max in the bottom. They're probably going to slowly wind this out. Let's see. Yeah, okay, well, maybe that's not the way I read it. But yeah, okay, Office Depot Inc. is a better indicator of that's the surviving entity. But at the point of analyzing the merger upon announcement, you wouldn't be able to see this yet, right? So how do you figure out really the details and the structure of the merger? We got to go to the SEC financials, right? And more than likely, you want to go to a proxy. Now, we didn't talk about proxies yet. We talked about it generally, but a proxy is a document used to solicit to shareholders to hopefully win their approval on the merger. Shareholders have to approve. And a proxy document is a great document to go to analyze merger situations because it contains a lot of technical information. It also contains what's called a fairness opinion, which is supposed to be an unbiased opinion from a third-party investment bank on the merger. So it gives you good valuation techniques, multiples, things like that. So what I would do after announcement to get into more detail is go to sec.gov. I'd go to the company name Office Depot or Office Max. They probably would both have something. Office Depot clearly still exists because they have financials as of November, last week. I'm going to go prior to, let's say, May 1st, 2013, because the announcement was February. And, you know, you'd pine through all these documents, and I just know from when putting together the book, the proxy that was out at the time was this 425 April 9th prospectus and communication of business combinations. So I had to poke through these documents, and one of them was like big and had a lot of information. So you might ask, well, how do I know to go to that document? It was just trial and error. I just kept clicking on one, and one was like 1 page, 2 pages. One's a big document that has a lot of information, and that will clearly talk about the merger. So is this the one? Nope, this is just 4 pages. Let me go back to the next one. They both had the same title, so you kind of had to poke around through it.
I think the size. Look at the size.
Oh, was it not this one? I had it open and ready on the break before the computer crashed. This one.
Yeah.
Where do you see the size?
Right there.
Oh, I see. The only interesting thing is that this is, it might be this, but I know it was April 9th. I know it was April 9th, but no, this is an 8K, and this just has exhibits. I wonder if it's fully loaded, because I had it opened. It might be the S4. Yeah, this is it. I know right away. You can tell right away the way this is loading up. There's a lot of pages. And it says right here, as it's coming up, proposed merger, your vote is important. This is a solicitation to stockholders. It has the two big logos right there. You notice that it's talking explicitly about the merger. It seems like the internet's slow here. But and it says right here, the board, so you can tell right away that this is a big document. Yeah. So what it states is the board of directors of both Office Depot and Office Max approve, make this bigger, the strategic business combination. That's not going to help with reading it. And they say that Office Depot stockholders will hold approximately X%, and Office Max stockholders will hold approximately X%. Once they combine, there will be a stock exchange. And they won't have that calculated. We can calculate that. And it also explains the core terms of the merger, which we talked about. The new Office Max common stock issued, so Office Max is raising the stock. They have the right to receive 2.69 shares of Office Depot common stock, together with cash. So Office Max currently trades, and they talk about like the core structure. So, you know, it's pretty simple in this case. We know it's a stock swap. The question is, what are the total sources and uses of cash then? How do we know percentage of debt equity? You know that?
I guess in the stock swaps on the list of the issues, 100% equity.
Yes. Be careful of that. Don't be tricked on that on the merger test. Because I give you guys a stock swap and then people do 50-50 debt equity. I don't know why. Stock swap.
Is the stock swap only possible for the public entity?
Um,
In a private company, do a stock swap? No.
you could do an equity swap, I guess, in some form, depending on who the interests are. But it's not going to be a public, obviously, stock swap.
You could call it equity swap.
We can call it an equity exchange. Yep, those happen. For important things to scan with the merger situation, because this is like 300 pages long, you really care about the financials, you care about the structure of the merger. So I'm not going to go through all of this, but obviously the point is, just like any 10K, you're not going to read this page by page, but you're going to use it as a frame of reference and resource, and there's important things to identify. One, if you're analyzing this on an actual transaction, you'd want to look at, they're going to talk about benefits and risks, right? Here's the main summary of the transaction. We talk about Office Max Inc., Office Depot Inc., what are the remaining entities, etc. One thing to note is actually this is not one transaction. This is actually 3 transactions. And the purpose of the first 2 smaller transactions, there's a chart below, is really legal and regulatory. So in other words, Office Max has a subsidiary. They want to eliminate that subsidiary. That's one transaction. They want to create a new entity to eliminate like preferred shares. There's a lot of things that go on in these deals, which is beyond the analyst's power. This is what takes 6 months to 12 months, sometimes 2 years to get these transactions done. The model that we build, the core merger of Company A plus Company B, that's just one piece of an ongoing transaction that is usually a result of a lot of legal proceedings. So really all we care about, though, to assess the financial impact is the key core merger, which is just the blend of the operations of Company A and Company B. But note that from a subjective standpoint, a lot of times a lot of things must happen before that merger can take place. Elimination of non-controlling interest holders, maybe a restructuring of the internal operations. A lot of different things need to go on, and this is a good example of that. We'll get to that in a second. Another thing to look for are the benefits and risks of the transaction. So there should be the next section here that talks about benefits and risks. This is selected consolidated data. We're going to replicate this in our merger model. think I passed benefits and risks. It's much better, though, from an analyst perspective, to not just use their consolidated information. It might be biased and it doesn't have projections. We have to create our own independent projections so we can know how to better merge them. Here are the risk factors. These are risks. So great if you're putting together a page that says, well, what are the benefits and risks? A lot of times you have to do that. That's laid out here. And then the next important thing is really the fairness opinions. So if we scroll down, we're going to find fairness opinions, which has basic accretion dilution. Here's the transaction, right? These are the two pieces. They're absorbing a subsidiary. They're creating an empty shell company. They're just doing a lot of reorganizations. The key merger, though, is this one right here, where Office Depot shareholders and Office Max shareholders combine and merge. And that's kind of what we're focused on. Okay. Here's a background of the transaction, all the discussions leading up to it. Might be interesting. Sometimes you have to put together a history page. And then again, the real importance of this, the heart of this, is the fairness opinion. So you want to scroll down real quick. These are their own projections. Take that with a grain of salt. You might run scenarios with management projections and our projections, right? So here is the fairness opinion. Opinion of Office Depot Financial Advisors. Did any of you guys have to do a fairness opinion during this internship?
Yeah.
You did?
Yeah, we did.
You did do a fairness opinion? So, okay.
The president transaction?
Yeah.
Okay. Well, it's basically a valuation or an analysis, and it's meant to be an unbiased view from a third party. So originally it was, the Office Depot has an advisor, Office Max has an advisor, and they're always battling about what numbers are right. So originally they said, well, let's get a third bank that doesn't have the buyers or sellers' interests to get a completely unbiased view as to what the valuation should be. And so now where that's evolved is you usually have three fairness opinions in a proxy. The fairness opinion of the buyer, the fairness opinion of the seller, and then the unbiased one. But it's important just to look at the fairness opinion because it does have valuation statistics. It has precedence. It has a lot of good information. So we will use this just as a proxy to check our work. So these are just some multiples. These are trading multiples. Here's accretion dilution. Notice that it's super accretive. Why could it be super accretive? Well, I didn't build the model. Why do you think it could be super accretive based on what we've discussed?
You're not issuing more shares, right? You're swapping stock, or
You issue shares in the stock swap.
okay.
Two things could make it so highly accretive. When we model it, it'll be around this accretion per share. Anyone can think about it off the top of their head? Synergies. What else? There's synergies. One. Maybe they're both, the combination of net income is so high. Maybe our company has a lot of net income. It's a merger of equals. So the merger could be exactly, or the acquirer's stock could be highly valued. So let's look at that. Those are subjective things to think about. Are the synergies so massive that it's creating all this? Or is just the incorporation and the merger of the earnings per share so big? Does Office Depot or the Tar Company have such high earnings per share that all the negatives don't outweigh that? Or three, is the equity being raised at a specific premium? Now remember, to clarify that, remember we spoke about in the mini merger model, the merger that was accretive, and we realized that the 100% equity case was actually accretive, when in theory, raising equity should be dilutive. And the exception to that was because the acquired stocks are very highly valued. If companies, if investors are willing to pay such a high price for a stock, usually advisors will go out and say, this is a great time to raise equity because people are paying such a high price for your stock. What does that mean? You can get a lot of money for less equity, for giving out less piece of the pie. So in situations like that, a lot of companies would actually, we saw this situation like AOL Time Warner where companies were raising equity to acquire, and it was actually accretive to their stock because people are paying so much money for that. So think about that. Okay. Well, that being said, and now that we have the basic statistics, let's look at the model that I had given you. And the model has several sections. It has Office Depot financials and Office Max. The model's been already built in line with street estimates. The goal is to merge them together in the same light as what's been represented by the press release. And so we have consolidated financials. This is what we're going to build. We have the income statement. We have then the cash flow statement. We're just going to do projections. We need to think about balance sheet adjustments and then laying everything out into a actual balance sheet working capital depreciation schedule. And the first thing we want to look to is the assumptions. And so how do we lay out what the core terms are? Well, we said from the line, from the press release and from the proxy, they're going to receive what? 2.69 is the exchange rate. And so Office Depot shares offered per Office Max is 2.69. That's the key element that we know is fixed. We also need the Office Depot and Office Max share prices. So Office Depot share price at the time, and we would just pull this from Yahoo Finance. Do I have it here in the note? Okay, as of April 4th, was, we got to look it up. I should have, I'll do this. So we don't have to be poking through the internet. Back to April 3rd. It was why is it so slow today? $3.77. $3.77. Okay. The Office Max shares was $11.21. I don't know what's wrong with this laptop today. Not responding, it's crashing. So this information I've pulled, and you want to make sure you're pulling it from the same date that's represented in the proxy, so we have equivalent data. Okay. And I've noted that, just to be clear, it said April, what was it, 11th, I think, 2 days after that announcement. And the reason why I picked April 11th is because they indicated that in the proxy. So while that's not responding again, let me go back to the proxy. And they should mention that date. And actually, when I was scanning through this, I discovered, and this is very helpful, I think it was page 160. So it's important to do kind of a scan. They lay out specifically the purchase terms, which is helpful. And I'll show you where and how it's helpful. It's helpful in giving us the date that they're analyzing it, so we can kind of back into that and use a similar date. Here we go. April 4th, 2013. Okay, I said April 11th. No, April 4th. April 4th. So I pulled April 4th, 4/4. The announcement was February 20th. The proxy was April 9th. That's right. But the proxy had information as of April 4th. So I want to go back and make sure I was backing into the same information at the same day so that I can use this table as a guide. Okay? Sometimes you might not have the benefit of this table. We'll look at this in contrast to the LBO that we do in Hines. LBO, they gave us different information, and we have to play up to whatever information we have and kind of back into things. So in this case, nice that we had this stuff, 377. This is the Office Depot common stock prices of April 4th, 2013. How do we use this information, the information that we gathered, the stock price and the stock, how do we use this information to calculate the estimated purchase price? What do you think? How do you do it, Daniel?
You want to look at what the shares outstanding would be.
Yes.
The total shares outstanding would be with that 2.69
Yep.
conversion.
Yep.
And then you want to take those shares and multiply it by the target's price.
Yeah. So we need to know the diluted shares outstanding. So we gotta dilute the shares of the target company. And usually you would have to go to the 10K, go through the diluted share case. We've done that before. What's beneficial though is here they actually explain to us that they've converted the shares for us, which helped us out. They say, here's the target company's common stock outstanding as of April 4th, 86985. This is the stock options as converted, so they converted the options for us, which is helpful. We don't have to do it ourselves, 3064. And they've also converted their Series D preferred stock. This is helpful because later we're going to see different tiers of stocks and we're going to say, oh, does that have to convert or not? We'll have to go out and go through that analysis. In this case, they tell us right away, they lay it out, we don't have to deal with it. In Heinz, not so easy. When we do the Heinz case, we're going to figure out how to convert it ourselves. But in this case, we know that diluted shares outstanding is 92749. So that's great. So we can just lay that out. Sorry, 92749. And since I want this in millions, I'm going to just list this as 92.7. I think I did 92.749. 92.749. 92.749 while that's loading. 92.749. And then the total Office Depot shares offered, how do we calculate that? Office Depot is going to give 2.69 shares for every Office Max shareholder out there, every diluted shareholder out there. So you multiply. You multiply 2.69 times 92.7. So they're going to have to raise or offer 249.5 million shares. So how do we figure that out? How do we back that into what the expected purchase price is?
249.5 times $3.77.
Yeah, the Office Depot share price. $249.5, 940.6, $940.6 million, almost $1 billion deal. Okay.
So when M&A announcements typically come out, the acquired shares typically go down, right, in trading.
They'll drop maybe 5%. I wonder what happened. We can analyze that. Yeah.
So that in this case, would that the same logic still apply because it's being calculated off of the acquirer's price, or would that what would normally happen? Because typically it's you would buy at the target price, so the market factors that in, and it brings it down.
Yeah.
The acquirement. So if it's the opposite, would it have gotten more expensive?
No, and the fact that we're doing this 1 month after announcement, we'd hope that that discount's already baked into the 377. It's after announcement that happens. So yeah, I wouldn't say we'd have to discount further. If we were doing a what if analysis and that stock price there was no actual announcement, then we'd probably want to model in a 5% discount. And actually, I'd like to go back and see, was this like $4 before? Did it drop already? Be interesting to see. Also good to know, the 940.6 ties with what they have here as the purchase price, 940.592. So we're good. We're kind of on the right track. And so note that the way we calculated the purchase price here was a little different than the way we've done it with these stock swap examples on the board. How do we do it on the board? Company A buys Company B for 2.69 times Company A shares. There's a couple ways to calculate the purchase price in the stock swap.
We take the target stock price, multiply it by the 2.69, and then see whether the options can get exercised.
Yeah, the acquirer stock price.
Yeah.
It's basically the same thing. we would go 2.69 times company A shares, means they're paying about $10 per share. And then $10 times the number of diluted shares outstanding, whoops, times the 92.7, sorry, 940.6. Make sure you're comfortable with, there's two different ways of looking at it. It's all about the order of operations. All right, and in this way, we said, all right, well, Office Depot is offering 2.69 Office Max shares. So for every Office Max share that's out there, every Office Max shareholder is going to get 2.69. So how many shares do they have to issue in total? 2.69 times the number of shares that are out there, 92.7. That means they have to offer in total 249.5 shares. So they got to go out and raise those shares at their stock price of $377. That's one way of looking at it. The other way of looking at it is if I was an Office Max shareholder, what would I be getting? I'd be getting 2.69 times the value of Office Depot, or 2.69 times $3. I'm getting basically $10 for every share that I have. So $10 times 92.7 is the same way of getting to that number. You're just, it's either, yes, it's either, oh, sorry. The math makes it so simple, but it's either number of shares offered times what? Office Max shares times what? Office Depot share price. That's what we did. Or the other way is number of shares offered times Office Depot share price times Office Max shares. It's the same thing. It's just what are you doing first? So people for some reason get so confused by that. You're doing the same math. It's just a matter of order of operations. Right? The first way, this is the way we did it in the Excel model. The way we've done on the board is, all right, well, number of shares offered times the value of Office Depot share price times the number of Office Max shares. Just multiply everything. Just multiply everything. But interesting to know that this is a discount to the target. They're getting a value. 2.69 times share sounds like a lot, but it's $10.14. It's actually a discount to the Office Max target shareholder, which is interesting. They voted and were willing to accept a discount, not a premium. What impact is that going to have?
So the price will pull down on the target.
Well, this stock price is going to be gone. It's going to be gone before the deal, maybe.
They have to raise less shares.
They were in more shares, 2.69. What else? What other different? You might not know it yet. Thing will happen to the model.
Something becomes more apparent.
Say again?
Becomes more apparent.
Well, it will, but I don't know if that's the reason for it.
Goodwill will be negative.
Goodwill negative. We'll have negative goodwill. Purchase price will be below book value. They're paying below book value. Not a premium. I wonder what led up to getting that, but.
And you actually see companies with negative goodwill on the balance sheet?
Yeah, you'll have negative goodwill on the balance sheet. It's not so common, but.
Pay less than the actual value.
Yeah. Pay less
So
than
why
that.
would they want to accept?
Maybe the business declining market share. They really believe in the growth story. They feel like that their value will, in the future, I wonder, what's Office Depot now at? Are they above 4? Maybe they figure once the merger happens, they'll regain those benefits.
So is there something actually to, in case the market is the value of the business is increasing fast?
Yeah.
To actually, or that would be like a gain for them afterwards.
It'll be a gain afterwards. So Daniel, what are they at?
7.66.
Wow. So there you go. So so in other words, $7.66. So even though they accepted a 10% discount, their stock more than doubled, right? They received 103% return on their stock. And they got 2.69 shares. So it's all right, well, I'll take this 10% discount, knowing that my value, they doubled their value for the shareholders. So that was a pretty good deal in the end. Yeah, no. I mean, now they are. But yeah, they're so similar. And I guess that was part of the reason, right?
Maybe that you're going to do better than that one. That's why
I don't know who was performing better. But yeah, I mean, yeah, it could be based on the performance. I mean, what did we say? We didn't look at this yet, right? Office Depot was at 27 cents a share. Well, that was the projection, right? They're at 3% a share. Office Max, the target company, was at, that must be based on a one-time thing, 40 cents a share, and that means that they were probably negative. Were they negative net income? No, that's interesting.
Was the advisor?
I gotta check. The fairness, this might be based on a one-time. I thought we did an adjusted. This is the adjusted. Oh yeah, Office Max had a negative earnings per share, but that was based on one-time items. Sorry, Office Depot.
Were they closing up locations? They were probably
400 million synergies. I mean, this is the key.
Yeah.
This is the key to the 130% accretion, was the synergies, was the combination operation. When they're so similar, maybe that's the value that they saw. The advisors were, I don't remember. So this fairness opinion was by, what's it called? Peter J. Solomon Company. But then there were two other advisors, of course. Morgan Stanley could have been one.
Aren't those like fair value, so they're not the actual advisor?
Well, I think that Peter J. Solomon advised Office Depot, and then there was two more, Morgan and Goldman. One was the unbiased guy. These are the right questions to think about. Those are the right questions to be asking as we combine the financials. Right? Office Max was clearly underperforming. Office Depot had like 30 cents a share. Where's the incentive? It's got to be in the synergies. And did they actually realize those synergies? We'll see. All right, what about the sources and uses? So this is kind of hidden here. Purchase price equity value of Office Depot shares offered. That's the core uses. That's what we just calculated. Now we have a question about the net debt. Do they absorb the net debt or not? The shareholders cannot be responsible for the net debt. So usually as an analyst by default, we just assume. But in this case, this is not our net. This is a merger. This has been discussed. We're not, if this is like a what if scenario, then we'd say, all right, well, maybe we'll default by assuming that we'll take on the net debt, we'll take the hit on new interest expense, and it'll be a benefit if we realize that we can roll over the net debt, maybe, or maybe it's not a benefit. How do we think about net debt? How do we understand or determine if they're going to absorb the net debt or not?
It's a stock swap, right?
It's a stock swap. So what does that mean? That's a good clue.
I think they're going to absorb it.
Okay, so first of all, if it's a stock swap, the funds from that stock swap, that's applicable to the purchase price, has nothing to do with the debt. If they're to raise debt, if they're to pay down the debt, they'd have to raise additional funds to pay down that debt. And there's really no indication of that, right? So you would often see, do I have the press release still? Where was the actual, you would often see, maybe this isn't a good example, you'll see this in like Heinz. You would often see Company A acquires Company B for a purchase price of about $1 billion, and total consideration of 1.5 billion, including the assumption of target company debt. They would indicate something about the debt. Or they would say something like, instead of purchase price, they'd say total consideration. If you receive the words total consideration, that means purchase price and other things, which must mean debt. There was no language like this, so it was kind of a guess. So that's clue number one. They would usually say something like total consideration includes, total consideration will be $2 billion, including the assumption of target debt. That's one clue. Nothing about total consideration here. And you would have thought in their major bullets here, they would say this also includes the assumption of $3 billion of target net debt. To contrast this, in Office Depot, we'll see that. They'll say clearly the total consideration will be $28 billion, including the assumption of target company debt. You'll know, right? Or you'll guess that. Second clue is because it's a stock swap, the terms here assume that they're paying just for the equity of the business, not the debt. The third clue is in the S4, did I go down? There is actually a suggested combined balance sheet. This is the biggest clue. And here's one thing I want to, this confuses a lot of analysts because, this balance sheet is basically their balance sheet adjustments. And this is an opinion, I would typically, let's see, we were at the, oh, you know what? I went the wrong way. A lot of times people will see a combined balance sheet and say, okay, well, my model has to match this. You'll never get it to match because this combined balance sheet includes a lot of one-off write-ups and write-downs that you could never predict. Things like AR, and they'll have like a guy looking at the AR and saying, you know what, X% of this AR is never going to come. We're going to write down this AR. Accounts payables, they'll look at the accounts payables and say, you know what, they'll have like a guy actually analyze every payable and say, you know what, this payable is over 3 years payable, write it down, Those things you can never model and predict. So you'll never tie into the exact numbers, and it doesn't matter. You just want high-level impact. Sometimes the write-up and write-downs of those ARs, these small adjustments that they're making, won't have a considerable impact anyway. Here's the combined balance sheet. So you'll never be able to tie. This is basically their balance sheet adjustments. This includes the major ones that we would include in our balance sheet adjustments, the sources and uses. It also includes a lot of little things that you're like, this 5,000. You're like, you know what, or the 6,000. I'm not going to back into that. You'll never do that. So a lot of analysts get confused and think that they have to tick and tie this together. My recommendation is this is a good thing because it gives you high-level clues as to how they're thinking about things. But for your model, for your projections, you'll never balance if you're not doing it the way we talk about on the board, meaning just using the sources and uses and applying it to the balance sheet adjustments. See what I'm saying? You'll never be able to tick and tie everything. But the clue that this can give us are how are they managing the debts? So for example, the long-term debt is staying on. You can see right here. There's a small adjustment of $6 million. If you look at note E, it was like a fee. Like a fee associated with rolling over the debt. If I saw a negative 225,962, I'd know they're paying down the debt. This is my clue. They're paying down the debt. Cash is being eliminated. This is my clue. Cash is being eliminated. This was not the 495. If you look at the notes, they also received cash by liquidating some investments and things like that. But I just want high level how things are going. And the biggest high level is, were they raising additional funds to pay down debt? So I have 3 clues in our favor now, right? One was they didn't mention it in the press release. They typically would. 2, it's a stock swap. So I'm not talking about the funds, additional funds being raised. And then 3, it's indicated in the balance sheet adjustment. So my point is, go-to places for you guys as analysts to know where to go to analyze these transactions. Even just the assumptions, they're things to look at.
So they're taking on the debt.
Yep. So we are not going to raise additional funds to pay down that debt. They're absorbing it. Net debt is 0. Transaction fees is tough. It's something they never really talk about. And so we kind of have to make, as an analyst with some of these things, as long as you're putting in placeholders that you're modeling and handling and being responsible for these things. So and they had no indication of that, and they typically won't. For a multi-billion-dollar deal in an M&A, it's usually somewhere around 0.1 to 0.3% of transaction fees. In like a smaller kind of boutique deal, it's anywhere from 1 to 5 to 10%. But 1% of a multi-billion-dollar deal is a lot. So I said, well, okay, well, it's not like a multi-billion-dollar deal. Like Heinz is like a $26 billion deal. This is like just around $1 billion. So I thought about 1% to 0.5%. I used 0.5%, and that was pretty much a guess, a ballpark guess. I could have made it 0, but there's fees are going to be allocated somehow. I did 0.5% of the purchase price. And we can argue back and forth about that, but as long as it's in there, you can hard code and change. That's what I'm looking for. So I'm going to do as long as I have something in there to get an indicator more for what impact that has on the transaction, and it's probably pretty small. And so the total uses is a sum of the debt and the purchase price and the fees, all the funds being raised. Got it?
So if it's $1 billion, why did the S4 say 18 million?
18 billion was the combined revenue. We'll look at that. And so for the sources, equity being raised is what? How much equity is being raised?
The total purchase price.
Total purchase price. This is an easy one. This isn't based on the percent of total capital, because we know it's a stock swap. Now, debt and cash on hand, does it matter? Well, we got 4.7 million left. And the question is, are they going to raise debt to pay those fees, or are they going to pay it with cash? And that was a bit of a toss-up. So, you know, they could really go either way. The way I looked at it was, well, who's going to be responsible for paying this? It's probably the acquirer, right? The acquirer is going to be responsible for paying it. The acquirer has $700 million in cash on hand. So that might go to some portion of funding. To me, it seemed kind of silly to raise $7 million to pay those fees. I guessed that they're going to pay that in cash. That was kind of a guess. It's such a small number, whether it goes into debt or whether it goes into cash. One impacts interest income, one impacts interest expense. It's a minimal impact. So I assumed that the cash on hand financed the transaction fees. This was small. And then I said, well, just to kind of have all things being equal, I linked debt raised to net debt in case we ever run a scenario that says, well, what if we pay down the target debt? We'll assume that it gets rolled over with the debt. The target company's debt was like $3 billion. So if they weren't going to pay down all $3 billion, the company does not have cash fund. They have $700 million in cash. They don't have enough cash to pay for that, and they'd probably want to pay a cushion. So to me, definitely, if they were going to pay down debt, they would have to roll it over. They'd have to raise additional debt to pay that down. That's more of a no-brainer. With the cash on hand, it's only $4 million. It could have went either way. And it's kind of clean in that equity comes from the purchase price, debt comes from over the debt, and then the cash is the transaction fees. So I summed everything up and matched the total uses with the total sources. Okay? And then the percent of total capital is just the percent of equity divided by total, which is going to be a majority of it. How much was raised in equity, how much debt was raised, debt over total, cash over total, 60% of the total. They should all add up to 100%. So, you know, the biggest takeaway here, although the mechanics were a little bit simple, but it's really how to think about it. Which, again, hopefully you're starting to realize the importance of the case versus just a template. The template was like, oh, 25% premium, great. How does that lay in mechanically? Now it's just more subjective. How do you interpret the actual case? And it's a little bit of a different way of looking at it. So tomorrow what I want to do is I want to say, okay, so what happens to the income statement now? How do we look at their accretion and take it from there? Any questions on this?